Options on futures are just like options on equities. There are many ways to trade them and many styles of trades. Both markets are traded based on the price of an underlying asset, which means the influence of option pricing and expiry will affect both types of trades similarly. When considering options trades, traders in either market will look at important factors like the time you want to be in trades, influence of Greeks, implied volatility, and the flexibility to trade options at the money, out of the money, and in the money. As an options trader, you can set up your trades with different expiry dates, which enables you to express a long or short-term view of the market. For example, an equity options trader could analyze Apple stocks and determine she wants to trade a bullish assumption, assuming she believes the stock price will rise imminently. This trader might purchase a call with an option that will expire in 2 weeks to take advantage of the anticipated move. The same is true for an options trader who analyzes the E-mini S&P 500 futures and determines he wants to trade with a bullish assumption and anticipates the move will happen soon. This trader could also choose to purchase a call option that expires in 2 weeks as well. As an added advantage, the options on futures trader can choose between a Monday, Wednesday, or Friday expiry for some markets, giving even more choices to trade. Another consideration for all options traders is premium and intrinsic value. A trade setup used to take advantage of premium and equity options in a stock like Google could also be applied in an options on futures market like the E-mini NASDAQ. And we're not just talking about options on equity futures. Even an uncorrelated market like crude oil can be traded in a manner to take advantage of implied volatility. For example, a contract in WTI might have high implied volatility, so a trader may decide to trade by selling a spread. Assume WTI is trading at $53 and is holding steady around this price after a big move upward and a recent increase in volatility. One way to take advantage of decreasing volatility is to sell the 52.50 put and buy the 52 put, creating a credit of 20 ticks or $200. The trader would be profitable if WTI closes above 52.30 at the end of the month. Just like equities, options on futures allow you the ability to choose to trade at, in, or out of the money, which will vary the cost of the options and its risk-reward profile just like any equity option. For example, a trader who thinks gold futures will skyrocket to new highs could buy an out-of-the-money call with the expectation that price will move through this strike. Assume gold futures are trading at $11.84. A trader might buy a $12.80 call for around $5.50. Gold would have to have a large move by expiry for this option to pay off. If the trader wants to more closely replicate the performance of the underlying futures contract, they could buy an in-the-money call, like an $11.70 call with the same expiry, but it might now cost around $38. Just like equity options, trades in options on futures can be placed at different levels, providing flexible participation in the market. If you understand equity options pricing information, then you can put that same knowledge to use when trading options on futures.